Most financial crises don't start with a crash. They start with a small number moving where it's not supposed to move. And when that happens, the damage doesn't stay local. It spreads fast. That's exactly what just happened in Japan, and almost nobody is paying attention. While the world is focused on the Federal Reserve, political noise, and crises like Venezuela, a single bond market quietly broke a multi-decade rule. And that break just put global liquidity at risk. But while everyone's glued to the Federal Reserve, the US election cycle, or whatever headline is trending this week, almost nobody is watching the one chart that matters most at the moment. The chart that just snapped a 25-year trend and quietly signaled the end of the free money era. I'm talking about Japanese government bond yields, especially the long end. Today, Japan's 30-year yield surged to 3.5%. The 10-year pushed above 2.13%, levels we haven't seen since 1999. Trading economics, +2. Reuters, +2. To most people, that sounds like the definition of boring. Japanese bond yields? Who cares? But to the institutional system that holds everything together, the funding markets, the leverage, the quiet trades that keep liquidity flowing, this is a big problem. Because for the last 2 decades, Japan has basically been the world's ATM. Rates sat near zero. The Bank of Japan kept the cost of yen funding absurdly cheap, and global investors treated that cheap yen like oxygen. Borrow it, convert it, and use it to buy anything that moves. US tech stocks, US real estate, credit, crypto, you name it. That was the deal. Free funding everywhere, all the time. But now the ATM is shutting down. The price of that funding just jumped. And when funding costs jump in a highly leveraged system, it doesn't feel like a rate move in Japan. It feels like a global margin call. So here was what we're going to do in this investigation. We're going to break down why a rate shock in Tokyo can drain liquidity in New York. We're going to walk through the carry trade, the hidden leverage that has been supporting risk assets, and why it was starting to unwind. And then we're going to connect the dots to the part most people aren't ready for. Why this kind of liquidity shock is exactly the kind of trigger that pushes capital out of paper and into hard assets, especially silver. Because when the system starts to crack, it usually breaks at the weakest link. And right now, the weakest link is the yen. This is the story of the Japan shock. To understand why 3.5% on a Japanese 30-year bond is such a big deal, you need to understand the game Wall Street has been playing since the early 2000s. It's called the yen carry trade, and it works like this. Imagine you're a hedge fund manager in New York. You want exposure to Nvidia, Bitcoin, or even treasuries, but you don't want to tie up your own capital. You want leverage, so you go shopping for the cheapest funding in the world. And for years, Japan was the answer. The Bank of Japan kept rates around 0%, sometimes even below zero. So funds borrow yen, say 1 billion yen, at a cost that's basically nothing. Then they convert that yen into dollars and buy US assets yielding 5%, 8%, 10%. They keep the spread. On paper, it looks like free money, and at scale, it becomes massive. Trillions, literally trillions, have flowed out of Japan into Western markets through this exact mechanism. It's one of the engines behind the liquidity bubble. Japan creates cheap yen, the world borrows it, and asset prices inflate. But there's one catch. This trade only works if Japanese rates stay low, and if the yen doesn't know how to rip higher against the dollar. If Japanese yields rise, your borrowing cost rises. Suddenly, your free money isn't free. And if the yen strengthens, your problem gets worse. When you go to repay, you effectively owe more in dollar terms than you planned for. That's what's starting to happen now. Inflation pressure is forcing Japan toward higher rates, and the 10-year pushing above 2.13% is a loud message. The era of effortless yen funding is ending. Reuters, Powell +1, which means the unwind begins. Hedge funds have to pay back those yen loans. And to pay back the loans, they have to sell what they bought with the borrowed money. They sell US stocks. They sell US bonds. They sell risk. And that selling wave has nothing to do with earnings or innovation or whether the economy feels strong. It's mechanical. It's forced. It's deleveraging. So why is 3.5% on the Japanese 30-year so critical? Because that level isn't just a headline. It is a potential tipping point for Japan, its biggest, most conservative pools of capital, especially Japanese life insurers. Japan is a country built on saving. For decades, households, pension funds, and insurance companies accumulated enormous pools of capital. But for nearly 20 years, the capital had a problem. It couldn't earn anything at home. Interest rates in Japan were pinned near zero, sometimes even below it. So the money did what capital always does. It left. Japanese funds sent trillions offshore. They became some of the largest foreign buyers of US treasuries, European government bonds, and Australian debt. Today, Japan holds over $1 trillion in US government bonds alone. That made sense when yields at home were zero, but the math just changed. Now those same institutions can earn 3.5% risk-free inside Japan, in yen, without currency risk. For conservative investors like pension funds and life insurers, that number matters. For years, Japanese institutions openly said the same thing. If domestic yields ever reached 3%, they would bring the money home. We're no longer talking about 3%. We're at 3.5%. That means the repatriation isn't theoretical anymore. It's starting. Japanese pension funds are selling U.S. treasuries. They're selling European bonds. They're pulling capital back to Tokyo. And that creates a very uncomfortable question for the United States. If Japan stops buying U.S. debt, who replaces them? China? China has been selling. The Federal Reserve? Supposedly tightening. If one of the largest buyers in the room quietly stands up and leaves, the price of money has to adjust. U.S. interest rates would need to rise to attract new buyers. And higher U.S. rates don't just stay on a chart, they break things. They hit housing. They stress banks. They tighten credit across the economy. That's the contagion. A rate move in Tokyo becomes a rate shock in New York. Because the global system isn't separate. It's stitched together by debt. And Japan has been holding a very large piece of that stitching. We've actually seen this movie before. We don't have to guess how the system reacts. On August 5th, 2024, Black Monday, the Bank of Japan raised rates by just 0.25%, a tiny move, and global markets buckled. Japanese equities collapsed 12% in a single day, the worst drop since 1987. Crypto sold off hard. U.S. tech stocks followed. Why? Because the carry trade started to unwind too quickly. Everyone ran for the exit at the same time. That was a warning shot. Central banks stepped in. Liquidity was patched together. The damage was contained. But now it's 2026, and the numbers are completely different. Rates are much higher. The pressure is exponentially larger. The Japanese 30-year yield is sitting at the highest level of this century. If a quarter-point move caused a global sell-off in 2024, what does a sustained move to 3.5% imply today? It implies a liquidity shock. And that's exactly why we're seeing volatility in gold and silver. In the early phase of any liquidity event, everything gets sold. Investors dump what they can to meet margin calls. They sell gold, they sell silver, they sell winners to cover funding stress. We saw that earlier this week. But once that forced selling is done, something else takes over, fear. And that's where the silver thesis really begins, because when the bond market breaks, the so-called risk-free asset stops being risk-free. If U.S. Treasury yields spike as Japan sells, bond prices fall, and investors who thought they were protected suddenly realize they're down 20-30% in assets they believed were safe. So they ask the only question that matters in a crisis. Where do I hide? They can't hide in the yen, it's volatile. They can't hide in the dollar, it's being diluted. They can't hide in bonds. Yields are rising and prices are falling. That leaves one place, hard assets. When the global carry trade unwinds, it destroys confidence in leveraged paper systems. Capital moves away from the financial economy and back toward the real one. Gold and silver sit at the center of that shift. They have no counterparty risk, no yield curve exposure, no dependency on central bank policy. The initial shock may be violent, but the aftermath is a migration of capital into precious metals. We've seen this before. In the 1970s, rates rose, bonds collapsed, and gold exploded higher. The pattern didn't change, only the scale did. So the ATM is closing. Funding costs are rising. Japanese capital is heading home. The real question is how fast this spills into U.S. markets, and what it means for silver sitting near $78. That's where we go next. In the next section, we're going to break down the mechanics of the unwind. We'll explain why repatriation creates a short-term dollar shortage but a long-term dollar problem. We'll walk through the U.S. Treasury trap, why Japan's selling forces the Federal Reserve into a corner, and how yield curve control re-enters the picture. The bond market is the fuse. Silver is the explosive. Stay with me. We're about to map the blast radius. Let's reset the board. The catalyst is clear. Japan's 30-year government bond yield has reached 3.5%. This level, the highest since 1999, marks something much bigger than a number on a chart. It signals the effective end of the carry trade, the decades-long strategy of borrowing cheap yen to buy higher-yielding U.S. assets. Earlier, we explained why this is a global margin call. Now we need to focus on the next question, the one that really matters. Where does the money go? When a margin call hits, capital doesn't disappear. It relocates. It moves away from risk. And in this case, it moves from west to east, from the dollar back toward the yen. This is where the repatriation vacuum forms. Japan holds roughly $1.2 trillion in U.S. government debt. That's not a rounding error. That's structural support for the treasury market. So the real question becomes uncomfortable very quickly. If Japan sells U.S. debt to rebuild strength at home, who steps in to buy it? That question pushes the Federal Reserve into a corner with very few exits. This isn't just a Japanese problem, I'm an American one. and it ions the fuel for the next phase of the silver bull market. Let's look at how we got here. For 20 years, institutional investors around the world bought U.S. treasuries because the math forced them to. U.S. bonds paid 4%, while Japanese bonds paid 0. You accepted currency risk. You accepted time zone complexity. You did it because there was no alternative. But now you wake up and see something completely different. You can earn 3.5% risk-free at home in Japan, in your own currency, without geopolitical risk and without FX exposure. For conservative capital, that's a no-brainer. So what do? You sell the U.S. Treasury, you bring the cash home, you buy the Japanese bond. That process is called repatriation. It sounds technical, but in practice, it behaves like a vacuum. It pulls liquidity out of U.S. markets, first from treasuries, then from stocks, then from housing. And most critically, it drains liquidity from the U.S. government itself. Japan is the largest foreign creditor to the United States. If they choose to sell even 10% of their holdings, that's $100 billion of supply hitting the bond market. When bonds are sold, prices fall. When prices fall, yields rise. And when U.S. yields rise, everything else follows. Mortgage rates climb, auto loans get more expensive, credit cards tighten, the economy slows hard. So a rate increase in Japan effectively becomes a rate hike for the United States, delivered from the other side of the world. The Fed didn't vote for it, but they're forced to live with the consequences. And it tightens financial conditions faster than any speech Jerome Powell could ever give. This is where the Treasury nightmare begins. The U.S. government is running deficits approaching $2 trillion per year. To function, it must constantly issue new debt. And for years, the debt was absorbed by foreign buyers, primarily China and Japan. But China has already stepped back. In fact, they've been selling. And now Japan is doing the same. So who's left? Hedge funds? They're leveraged. U.S. banks? Their balance sheets are full. That leaves one buyer, the Federal Reserve. This is the trap. If foreign demand collapses because Japanese yields are suddenly attractive, the U.S. Treasury market destabilizes. Yields don't drift higher. They jump 6%, 7%. At those levels, the math breaks. At 7%, interest expense alone threatens the solvency of the U.S. government. So the Fed cannot allow yields to rise freely. They're forced to intervene. They become the buyer of last resort. They print new dollars to absorb the bonds Japan is selling. That's called monetizing the debt, printing money to pay your bills. And once markets realize the Fed is the only buyer left, something clicks. The supply of dollars is no longer constrained. It goes vertical. And that realization erodes confidence in the currency itself. Which brings us to the other side of the trade. What's the anti-dollar? Silver. This is why the Japan shock is so bullish for precious metals. It forces the Fed to print, even if they don't want to. They have to absorb the selling pressure. In effect, Japan exports its inflation problem to the United States. There's a term you're going to hear constantly in 2026, yield curve control. Japan used it for years. Now the U.S. is being pushed toward it. Yield curve control means the central bank draws a hard line. They say the 10-year yield will not go above 4.5%. And if the market challenges that line, they print unlimited money to enforce it. That's not policy strength. That's surrender. It means inflation is no longer the priority. Government solvency is. And once yield curve control is announced, or even hinted at, the bond market turns into a zombie. Returns are capped. Risk is uncapped. Capital looks for the exit. And it doesn't stay in bonds. Returns are capped. Cash doesn't work either, because inflation isn't capped. So the money has to move. That's the mechanics of what economists call a crack-up boom. The real economy may be struggling. Growth may be weak, but asset prices rise anyway. Not because things are healthy, but because the currency is being diluted to keep the bond market alive. And this is where silver moves to the center of the story. Silver is one of the primary beneficiaries of yield curve control for a simple reason. It can be diluted. It has monetary history, but it also has real-world utility. You can't print it. You can't cap its supply with policy. Japan's move to 3.5% doesn't just matter domestically. It pushes the United States one step closer to inevitable yield curve control. And once that path is chosen, the clock starts ticking. Now, a fair question comes up here. Why silver? Why not just gold? Gold will do well, no question. But silver has something gold doesn't, leverage to the industrial economy. Remember where this shock started. Japan isn't just a financial power. It's a manufacturing giant. Toyota, Honda, Panasonic, Sony. These companies rely heavily on silver across electronics, energy systems, and advanced manufacturing. As repatriation strengthens the yen, Japanese purchasing power rises. Raw materials become cheaper in yen terms. That gives Japanese industry more flexibility to secure long-term supply and build strategic stockpiles. So stronger yen doesn't slow demand, it supports it. In other words, Silver gets hit with a double impulse: monetary demand from the West and industrial demand from the East. Asia drains physical supply while Western investors scramble for protection. And there's another layer most people miss. Silver is the people's hedge. When the average person feels the system wobbling, when they see currencies weaken and bond yields spike, they don't rotate into treasuries. They don't buy futures contracts. They buy something simple, something tangible. They buy a coin. That retail response is driven by fear, not spreadsheets. And when the carry trade unwinds, volatility spreads fast. That volatility pushes people toward safety. And silver sits right at the intersection of affordability and trust. So now you have two forces working at the same time. Monetary demand, the Fed printing to absorb the bonds Japan is selling. Industrial demand, Japanese manufacturers using a stronger yen to lock in supply. Different paths, same destination, higher silver prices, capital is moving home. U.S. debt is losing its natural buyers. The Federal Reserve is boxed in. Which brings us to the next question, the one that keeps regulators up at night. What happens to the banks? Because banks are the ones who enabled this entire structure. They're the ones who lent the yen. They're the ones who financed the carry trade. And now those loans are starting to sour. This is where the stress moves from governments to institutions. In the next section, we're going to examine the banking contagion. We'll identify which US and European banks are most exposed to rising Japanese rates. We'll open up the derivatives book, the massive opaque web of bets tied to interest rates staying low. And I'll explain why a spike in global yields doesn't just cause losses. It punches holes in balance sheets. Even if inflation remains elevated, this kind of stress forces a pivot. Not because policymakers beat inflation, but because they lost control of financial stability. Silver thrives on that kind of pivot. We've tracked the shockwave from Tokyo to Washington. We've seen how higher Japanese rates drain liquidity from the U.S. Treasury market and force the Federal Reserve into the role of buyer of last resort. But there is still a critical layer between sovereign debt and the real economy, the banks themselves. For 20 years, the global banking system was built on one core assumption: that interest rates would stay low forever, that the yen would always be the funding currency, that leverage was safe. Banks stacked trade on top of trade, derivative on top of derivative, building a tower of exposure on that belief. With the Japanese 30-year yield at 3.5%, that foundation has started to crack. To understand how fragile it really is, we need to talk about scale. The notional value of the global derivatives market is estimated somewhere between $600 trillion and $1 quadrillion. Now, notional value isn't the same as direct losses. The actual amount at risk is smaller, maybe around $20 trillion, but even $20 trillion is enormous, and that's the next blast radius we need to examine. Most of the exposure sitting inside that derivatives universe comes down to one thing: interest rate swaps. Here's the simple version. A bank enters a contract where it receives a fixed rate and pays a floating rate. The bet is straightforward. Rates stay stable, volatility stays low, and tiny movements can be harvested for profit. With enough leverage, even small spreads turn into meaningful returns. That strategy only works in a calm world. Japan just ended that calm. By allowing rates to rise, Japan didn't just change its own market. It pushed pressure through the entire global rate structure. As Japanese yields climb, global yields follow. And when global rates move, the floating side of those swaps moves against the banks. If you're lightly leveraged, that's uncomfortable. If you're heavily leveraged, it's dangerous. We don't yet know the full extent of the losses, but the early signals are there. In Japan, Norinchukin Bank has already reported significant losses tied to foreign bond positions. In the United States, major banks are still sitting on hundreds of billions of dollars in unrealized losses from earlier rate increases. The math makes one thing clear: someone is hurting. And in a tightly connected system, pain doesn't stay isolated. When one counterparty starts to bleed, everyone feels it. Now let's talk about the hedge funds. Hedge funds were the ones who actually executed the carry trade. They borrowed the yen. They put on the leverage. But hedge funds don't borrow directly from central banks. They borrow from prime brokers, the hedge fund-facing arms of major global banks. So when a hedge fund blows up because the yen moves against them, the fund may go to zero, but the loan doesn't disappear. That loss travels upstream. The prime broker absorbs it. The bank is left holding the exposure. We've seen this movie before. When Archegos collapsed, a single fund wiped out $5 billion at Credit Suisse. That wasn't a systemic crisis. It was one failure. Now imagine multiple funds under stress at the same time, all tied to the same funding currency. That's how localized losses become systemic risk. As banks begin to realize their clients may not be able to pay, behavior changes fast. Credit tightens. Banks stop lending to hedge funds. They stop lending to each other. Capital gets hoarded to plug balance sheet holes. And when credit freezes, the economy freezes with it. This is where the pressure shifts directly onto the central bank, not to save growth, not to protect jobs, but to stabilize the banking system from its own risk-taking. Which brings us to the Federal Reserve's real dilemma. Officially, the Fed has a dual mandate: price stability and maximum employment. Unofficially, there's a third mandate that always overrides the others when stress appears: financial stability. Right now, inflation hasn't magically disappeared. By the textbook, rates should stay higher, but the Japan shock is putting visible strain on banks, and history is very clear on what happens next. When financial stability collides with inflation, stability usually wins. That's why a pivot becomes likely: rate cuts, liquidity facilities, possibly even renewed quantitative easing. Not because inflation was defeated, but because something broke, and broken systems get patched with printed money. That's why this environment is rocket fuel for silver. Silver benefits from inflation, but it benefits even more from inflation caused by policy failure. When markets realize the Fed has stepped back from the inflation fight to rescue the banking system, confidence in the currency erodes. Investors understand what's happening. Their cash is being diluted to absorb losses created by leverage. And when that realization sets in, money moves out of paper and into metal. That's why we call the pivot a panic pivot. They're not pivoting because they won. They're pivoting because something snapped. Now let's bring this back to something practical: your portfolio. Why does a banking crisis matter to a silver investor? Because of counterparty risk. If your silver exposure lives inside an ETF, a pooled account, or a futures contract, there's a counterparty on the other side, usually a bank. If that institution runs into solvency stress because funding trades unwind, your claim becomes part of the bankruptcy chain. You're an unsecured creditor. Physical silver doesn't work that way. A silver coin doesn't care if a bank is solvent. It doesn't care about swap spreads or Japanese yields. It stands on its own. That's why, during banking stress, capital doesn't just leave stocks and bonds. It leaves interconnected systems altogether. It moves toward assets without counterparties: gold, silver, land. This is the flight to quality, and we're already seeing the early signs. Premiums on physical coins are rising. Availability is tightening. People are beginning to understand the risk of leaving wealth inside a system under strain. The Japan shock is the fire alarm. Smart money isn't panicking. It's quietly checking the exits. And the exit isn't a screen or an account. It's a vault door. So here's where we stand. Bonds are under pressure, banks are stressed, and the Federal Reserve is boxed in. Liquidity may flood the system to prevent a collapse. Which brings us to the final question. What does all of this mean for the price of silver in 2026? In the final section, we're going to lay out the targets. We'll look at how silver responded to past liquidity injections, map the potential path forward, and deliver the final verdict on the Japan shock, and what it means when the butterfly finally turns into a storm. It started with a small move. Now the wind is picking up across the silver market. This is not a calm environment. Volatility is part of the forecast, and that's why preparation matters. We've reached the final chapter of this investigation. We traced the shockwave back to its source, the trading desks in Tokyo, where the 30-year yield pushed to 3.5%. We followed that pressure across the ocean into the U.S. Treasury market, where bond selling accelerated. We watched the stress spread through banks, balance sheets, and the derivatives complex. Now there's only one question left, the one that actually matters to your portfolio. What happens next? If banks are under stress and the Federal Reserve is forced to pivot, where does silver go from here? History gives us a very clear roadmap. Every time the financial system breaks, whether it was 2008 or 2020, the response follows the same pattern. First comes the shock, then comes the intervention. And that intervention always means one thing: central banks create money. And when that happens, silver doesn't just drift higher, it moves violently. Let's rewind. In 2008, the banking system collapsed. Lehman Brothers failed. During the initial liquidity crunch, silver crashed from around $20 down to $9. Forced selling does that. But then the Federal Reserve launched quantitative easing. They printed money to buy bonds and stabilize the system. What happened next? Silver went from $9 to nearly $50 over the following 3 years, a move of more than 500%. Now look at 2020. Markets collapsed during the pandemic. Silver dropped to about 12. Then the Fed printed roughly $3 trillion in a matter of months. Silver ran from $12 to $30 in less than 5 months. The sequence never changes. Crisis causes liquidation. Liquidation forces printing. Printing fuels the rally. The Japan shock is the crisis phase. Right now, we're in the unstable middle, where things are breaking, funding is tightening, and volatility is high. But the final phase is unavoidable. The Federal Reserve cannot allow the Treasury market to fail. When intervention arrives this time, it starts from a very different level. We're not starting at $12. We're starting in the 70s. A simple doubling from here puts silver near $150. And that brings us to the macro endgame: yield curve control. Japan ran this playbook for years. Now they're stepping away, and the United States is being pushed toward it. As Japanese investors sell US bonds, yields rise, but the US government cannot afford materially higher rates. The interest burden becomes overwhelming. So the Fed steps in, they cap yields, they draw a line and say the 10-year Treasury will not be allowed to rise beyond a certain level, say 4.5%. And to enforce that line, they buy whatever the market sells. Unlimited supply of dollars, limited yield on bonds. That combination destroys bonds as a store of value. Investors aren't confused by this. They understand the math. If yields are capped and inflation isn't, holding bonds guarantees a loss in real terms. So capital rotates out of sovereign debt and into hard assets. That's the great rotation. And silver sits at the center of it. Silver is the smallest and tightest of the major hard asset markets. When large pools of capital try to move into a market that small, price stops behaving normally. It stops trading on supply and demand alone. It starts trading on monetary flight. So what are the targets? Let's use the ratios. Gold is trading around $4,500. In monetary crises, which is exactly what yield curve control represents, the gold to silver ratio compresses back toward historical norms. In the modern era, that average is roughly 40 to 1. $4,500 divided by 40 gives you about $112 silver. That's the conservative case, and it assumes gold goes nowhere. If stress increases, if we see a bank failure or a deeper policy response, the ratio can compress to 30 to 1. That points to $150 silver. And in a true panic, a 1980-style blow-off, the ratio can reach 15 to 1, which implies $300 silver. So the roadmap is clear. Target 1, $100. Target 2, $150. Target 3, $300. At current prices, that's a potential 2 to 4 times move. That's what makes this asymmetric. The downside is limited. Industry needs the metal. The upside is uncapped because currency confidence is eroding. But the path there won't be smooth. The move from $70 to $300 won't be a straight line. It will be volatile and uncomfortable. There will be days when silver drops $5. There will be shakeouts driven by margin calls where strong hands are tested. Those moments are designed to scare you out. When you see red days, remember what's actually happening. Remember that the global funding ATM is closing. Remember that liquidity is leaving the fiat system and moving toward the real one. Volatility is the cost of admission. If you're unleveraged, if you own the metal, you can stay in your seat. The only people who get hurt on a roller coaster are the ones who jump off mid-loop. So here's the verdict on Japan's 30-year yield. It's the pin that pops the bubble. It marks the end of cheap money. It forces global capital to go home, and it corners the Federal Reserve into printing to save the bond market. For silver investors, this is the signal we've been waiting for. The macro tailwind is now blowing at hurricane strength. The micro fundamentals are tight. The geopolitical backdrop is unstable. And now the macro trigger, Japan and bonds, is in place. There's very little left holding price down except paper pressure. And paper burns when rates rise. You saw the debt dynamics before most people did. Now it's just a matter of letting the math work. The yen is moving, the bond market is cracking, and silver is next. Hold steady, the repricing has begun.